Next speaker is Peter Kerr, CEO of Mount Gibson Iron. Peter's a chartered accountant with over 20 years' experience in the mining industry in both Australia and Canada. He has held senior roles with companies in the iron ore, gold, uranium and base metals sectors. He joined Mount Gibson as CFO in September 2012 and was appointed into the CEO role in October 2018. Over to you, Peter.
Thanks very much, Jane, and thanks all for listening to the Mount Gibson story, and in particular to the organisers for asking us back. Last year we presented for the first time for a number of years, and our focus has been on iron ore mining in Western Australia. We're a mid-tier company, not presently active in and around the confines of Kalgoorlie, but we are active in the Midwest region of WA and up in what is a very popular tourist place at the moment, up north of Broome in the Kimberley. So it's a privilege to be back. The usual disclaimers there. So just as an overview of Mount Gibson, what do we own and do? We have two key operations. Up in the Kimberley region, as I mentioned, we have Koolan Island. It's a former BHP iron ore mine operated by BHP from the 50s, 60s through to the early 1990s, and Mount Gibson acquired it in 2006-07. It's a high-grade hematite deposit, one of the highest grade ones in the world, certainly in Australia. Think of it as a very iron-rich sands type deposit. We're mining on an island, which is difficult at times, but is a wonderful location to operate. The reserve grade there is 65%, hence the high-grade nature I'm talking about, and I'll refer to that shortly. Last financial year we sold 1.8 million tonnes, and that's during a time when we are actually doing an extensive waste cutback to set the mine up for the following 5 years. Our sales and cash flow following that waste cutback will be significantly higher. And in the Midwest, Mount Gibson's operated there since 2004, well before my time with the company. Previous management teams have done a terrific job inland of Geraldton, and the mines there have been Tallering Peak and Extension Hill, and now we're starting a mine called Shine, which was purchased by Mount Gibson back in 2013-14 and has sat on hold for a number of years, but with the iron ore price as it is, it's a great opportunity to put that into production, and I'll show you some more detail of that in due course. The Extension Hill operation ran from 2011 and finished at December last year, and that mine produced plus 25 million tonnes. I think the original target was something like 12 or 13 million tonnes. It was a great outcome for the company. In particular, the last couple of years enabled the shipping or transport and shipping of low-grade material into, at times, what was quite a tight market, but it's been a great outcome for the people there. And the people and the team we had at Extension Hill moved through to Shine, hence that operation has had a really good start-up. We do have a rail refund running from the Midwest, and that's based on the money that Mount Gibson's paid over many years for rail access through that part of the world to Geraldton Port. And in exchange for that, on the basis that Mount Gibson achieved certain tonnage amounts, it gave rise to a refund in due course, and that's based on the tonnage that other groups do on that rail system. So at the moment that's coming at a rate of about $2 million a quarter, and we're about 16 million through a cap of circa 35 million on that, so a really good income stream for us. We're also earning some additional income streams from the use of surplus capacity in the Midwest, and I'll talk about those separately shortly as well. Corporately, just a quick snapshot. Not a lot has changed as far as issued capital since a year ago. The market cap of the company is about 1 billion. It's backed by a large cash balance of about 365. We are using some of that to invest in the waste cutback at Koolan currently, and also for the start-up of Shine, but that's largely completed now. We're in the ASX 300 index. We have no bank borrowings, and we have been a dividend payer, both in cash and share-based dividends for a number of years, about 309 paid out since we started doing that. The shareholder base of the company, about 1/3, or a bit more than 1/3, is owned by Hong Kong-listed mining investment fund, APAC Resources. It will be familiar to a number of you. It is involved in various Australian resources companies. About another third is held by institutional holders in Australia, the UK, Europe and the US as well. And then other shareholders of note, one of our customers has about 13.5% currently sitting on the register and has been there since 2008, if not prior to that time. The board and management team are listed there on the bottom right and haven't changed since last year. So in terms of group highlights for what we've done in the last 12 months to 30 June, we haven't yet published our financial results, but these are the high-level data points. We sold 3 million tonnes, which is at the lower end of our scale as to what we've been doing for many years, but that's based on the plan we have at Koolan Island for the cutback in order to access the high-grade material from later this year. And that was made up of that 1.8 at Koolan and 1.2 from the Midwest. So what we produce in a year, the big boys produce in 1 to 2 weeks. We know that, but we are a niche player. We like our area in the Midwest and very much so in the Kimberley, and we want to continue to be able to extend our mines in that area. Cash and term deposits, I mentioned, was 365, and our cash cost for the year just gone was 66 Aussie FOB per tonne that we sold. And that was before our capital investment projects, which I'll talk about shortly. The operating events in the year, Koolan will come to. It's really been an investment year in waste movement, accessing ore, and also upgrading the crushing facility, which is quite old. We also have a new jet airstrip which we've started, and that has enabled us to do direct Perth to Koolan charter flights 2 days a week, and been a real boon as far as more productivity from the workforce given the previous travel that involved going through Broome and small charter flights. Shine has commenced, and that's a 1.5 million tonne per annum operation of about 59% hematite iron ore, lump and fines products. And we completed the low-grade program in Extension Hill that I talked about. That low-grade program ran since 2019, sold over 4 million tonnes and created $30 million in cash flow for us. So it was a great outcome by the team there. We'll obviously provide our profit results and further guidance for the year when we come out with our annual results shortly. Iron ore pricing, as it impacts us, there's no surprise here that we have extremely elevated levels of iron ore pricing. What these charts show on the top left is in black the standard nightly news 62% iron ore price for delivery in China, and then yellow underneath that is the 58% FE index, and the red is the 65% FE index. At different times, depending on the products we are selling and others are selling, those indices can be referred to in various contracts or as data points. And you can see, obviously, that that's risen to levels that probably no one really expected a year or two ago. In terms of the high-grade premium and low-grade discount, that's the chart on the bottom left. What that's showing is the percentage premium or discount, grade adjusted. And what you can see there is buyers are still willing to pay a premium of about 10% for high-grade material, and the discount that needs to be offered on the lower grade material, in this case the 58 index, has blown out a bit. It's gone from circa 10% a little while ago, now sitting in the low 20s, and that's shown by the yellow chart on the yellow line on the bottom. So our exposure at Mount Gibson is to all of these prices. We sell a mix of low, medium and high grade material. We're obviously moving to get back into the very high grade material as soon as we can at Koolan, but also from the Midwest we look at a range of products. And shine will be very important for us because we'll be able to produce more of a lump quantity, which Koolan at this point does not. Koolan is predominantly fines, and that lump premium at the moment is at attractive levels as well. So just turning to Koolan now, I know some of you have been there. I've had comments from people that you've travelled past or over or on at recent times, and it's a wonderful place, about the size of Rottnest Island, so 10 kilometres long by a few kilometres wide, runs east-west approximately. The main pit is shown on the southern side there. That's a 2 kilometre long, 300 or 400 metre wide pit at its widest, and that's the key source of high-grade material. There are other satellite deposits, and we are mining in one of them at the moment called Acacia East that's listed on the island, and that just supplements our mid-grade material. Everything is on the island. It is a standalone operation, so things are either flown on or barged on. Everything as far as iron ore exports is concerned is handled out of the port, and I'll show you a picture or two just to show here. This is not an operation that has high transport costs. The costs at this operation are really linked into the mining and operational aspects, whereas in the Midwest, the transport costs are more of a bigger feature of our business there. In terms of Koolan Island in a little more detail, 1.8 million tonnes sold for the year, as I mentioned. We made operating cash flow of 121 million, given the prices that were there, and we invested that and a bit more in the waste cutback that we need to do. We've stuck to the plan. It's a life of mine plan that had an original circa 7-year life. We're in year 2, and we are moving through that in terms of providing the waste to get the access to the high-grade ore. The other improvement projects relate to things such as the airstrip, the crusher upgrade and other pieces on the island. The cash costs were $70 Aussie per tonne, which was a little bit lower than the prior year, which was at 99, but that was before the capital costs that we are incurring on the island. But at least on an operating basis, we're comfortable where we are. We moved over 20 million tonnes of material, that's waste and ore. Obviously, the waste was the lion's share of that, and our strip ratio now will start to decline, and we'll reach the point where our grades will start to rise very shortly, our strip ratio will fall, and with the commensurate cash flow impacts. This is a picture of the open pit, standing above the eastern end, looking to the west. And just in stylised form, the ore body sits on the right-hand side at the base of what we call the footwall, and then the hanging wall and the seawall embankment that's been constructed there are on the southern side. The seawall is performing very well to design. You may recall that that slumped some years ago and the pit flooded. It's been rebuilt. A seepage barrier has been installed within that wall. You can't see it from that picture, operating very effectively. Our plan this year is to be largely moving a lot of that waste on the hanging wall side, focusing on the western end of the pit, so the far end that you look in this picture. And as you go through, you'll see, or as we go through that, we'll get deeper into the western pit to the high-grade material at the bottom. Effectively, in the base of that pit, you're either in the ore or you're not. So it's 65% or even slightly above, or it's not there, or it's very halo on the low grade on the footwall side. In terms of mining operations, I've touched on the tonnage movements, and so our focus now in terms of our people, our work with contractors, we self-perform on the island. So Mount Gibson owns or hires the trucking fleet, owns the excavation fleet. Sometimes we hire to supplement that. We have people who are reasonably long-standing on the island. They know how to operate. It is logistically challenging at times, but from the basis of what's on the island and already installed, we think we have a good position to turn that next 5 years into a very positive cash flow creation opportunity for the company. The average waste to ore strip ratio that I mentioned in the previous slide is now set to reduce as we move through this peak waste period. The geotechnical aspects on the island, many people know about. You can imagine a pit that's fairly long and narrow by the ocean does require a lot of careful thinking on geotechnical pieces. That involves both seawall and hanging wall side as well as footwall. And one of the things we have started, and this will run for the balance of this year, is higher levels that were mined back in the BHP days. We are doing some ground support work there with drills that are actually hanging off that 45-degree wall. And those drills are actually drilling, self-drilling anchors, varying between 9 metres and 18 metres in length, into that wall to ensure that we have no skin slips. We had one in October last year. It wasn't a large volume, but it was unexpected, and it caused us to rethink above the existing or the more recent geotechnical work areas that we've followed, what we would do to ensure the safety underneath. So we have a specialist contractor with those wagon drills on the wall at the moment, and we have divided the wall into priority areas, and we're moving through those to match the underlying mine plan, which will be deeper levels. In terms of the other capital project at the island at the minute, the crushing facility was originally built in 2006. Some of that was used materials to start with, so we knew at some point in the future, if we were successful in being able to design and work through to the high grade of the bulk of the ore body, we would need to do something with the crushing facility. That's what we're doing now. We're working with a contracting group. The program involves two key stages. The first stage has been completed. That basically has seen some of the conveyor systems and the orientation of the lump and fine circuits changed. And then the second stage is coming in over the next few months. The idea it will be complete in the December quarter. So it's an investment of 20 to 25 million, and we've already spent about 11 of that up to the end of June. It's important for us because we know the iron ore quantities are going to rise quite considerably, double or triple what we've currently been doing. And that's important from the perspective of being able to be a good, reliable supplier of this high-grade material. There is a picture just to demonstrate what my comment before about the logistics of the crushing circuit. So on the right-hand side is actually the ROM pad. Into the crushing circuit. You can see piles of crushed material stockpiled there, that's for high-grade fines. And then that vessel that was being loaded, I think back in May or June, you can see is at the wharf facility. So everything we need is there. Vessels actually moor a few kilometres outside the channel and then are berthed through arrangements with pilots and tugs and take about 2 days to load. Vessels there in the new Panamax, called it a Kamsarmax style ship, take about 80,000 tonnes. So over the last 6 months, our shipment sizes have increased from circa 70 to now 80,000 tonnes, which helps us with our loading unit costs as well. In terms of other things we're doing on Koolan Island, there are a number of other possible extensions for the mine life. They are incremental. I would describe it in the main pit. That means at depth there will be some opportunities, but also along strike to both the east and the west. There are some opportunities there. The grade is not as good as the high grade in the core of the deposit, but we know that with some mine planning and looking at the cutback waste to ore strip ratios there, we'll be able to extend some of the reserve that we're looking at. Some of those areas are not in reserves, I should say all of those areas are not in reserves currently. Likewise, the Acacia East satellite pit that we're mining doesn't sit in reserves. Mangrove is a deposit, you might see it on the centre bottom of that picture. It's a deposit that's been drilled previously, current resource of about 3 million tonnes at a grade of circa 59 to 60% iron. Represents a very viable target for us. We have now in the last few months secured heritage and traditional owner clearance to be able to access that again, and we'll be looking to do some additional drilling, and depending on the results of that drilling, and we're quite hopeful, add that into the mine plan as a blending source for the high grade material in future years. And then last slide on Koolan, the airstrip that we constructed last year, it was opened in November. That's pictured in the main part of that picture is the official opening with the Dambimangari people, the traditional owners of the island. So we're running Qantas jets twice a week in there at the moment, F100s, and that's proving very useful with our FIFO workforce who previously came through Broome and then hopped on Cessna Caravan planes onto the island. We still do use Broome and Derby as a base for our people. We have about 20 to 25% of the workforce residing locally in the Kimberley, which we are very happy about, and we would ideally like to secure more people from the Kimberley if we could. And they obviously don't fly from Perth, they fly directly onto the island via the smaller charter aircraft. But that was a wonderful opening and opportunity for us. And beyond mining, there is some real value here potentially in other uses for this airstrip, which are under discussion with government and other parties as well. But for the moment, we're concentrating on the key use being for our mining operations. So now just switching to the Midwest, inland from Geraldton. This picture shows the start of mining at Shine back in March. It's one of the mining crews with one of the first loads that came out of the pit. We're very proud to be able to commence this operation, and the team there has quite a few members from the original Extension Hill team and also some personnel from our coolant operation as well who've transferred. Shine itself, as you can see on that picture, Geraldton's on the left-hand side, about 250 kilometres as the crow flies inland is Shine. The top mine in the top centre, Tallering Peak, is where Mount Gibson started in the Midwest, and the bottom right is Extension Hill, where we've been mining up until December last year. So Shine itself is only about 85 kilometres north of Extension Hill. The reserve is 2.8 million tonnes at 59.4% Fe. So it's not a massive reserve, but this is the stage 1 pit that will see us going for a couple of years. And next year we have a decision as to whether we go into stage 2, which could see an equivalent volume and grade of material be able to be exported. That will require some mining design changes for next year, and they're being worked on now. We produce lump and fines products, and our capital expenditure, our targets were 20 million for development and about 15 million for, on top of that, for pre-production. And up to the end of June, we'd incurred about 29, so we're well and truly in line with our estimates there. The transport to market is currently via road, 300 kilometres into Geraldton, and first shipment is scheduled for about 3 weeks' time. So we'll be very pleased to get that shipment out. There is the potential to generate significant cash flows here at these prices, and if prices were to come off, and I'll come back to prices at the end, but if prices were to come off a bit, as we expect they might, and we certainly plan for it, the operation is still cash flow positive and has, based on the work we've done at Extension Hill in the past and our experience there, great potential for us to gradually pull those costs down on the site from an operating perspective and in transport. And there are some transport options for us. One of them is actually going by road to Mullewa, and at Mullewa we own a railway siding called Ruvidini, and there's an opportunity for us to actually use Ruvidini as a hub and to put stockpiles there and then blend and then rail the last 110 odd k's into Geraldton. And that's under feasibility now, and we're working through that initial agreements on trying to do that for some stage in the 21-22 financial year. Just a few pictures to show you the site. It looks very similar to Extension Hill for those who may have been there. It's been created from nothing in about the last 5 months, 6 months. It's been a very good job. On the centre top of that picture is the Shine open pit, and down the bottom, administration through to maintenance workshops and then crushing facilities and the crushed ore stockpile areas. The pit itself is about a 1 kilometre long pit, a couple of 100 metres wide at most, and we're mining in the southern area you can see here at the moment. You might even see the darker colours moving up through the centre of that pit. That's the iron ore that was either outcropping or close to outcropping. And we will in due course be moving to the northern end of the pit. We've worked closely with the traditional owners, the Widdy group here, and have had good liaison with them on the site and made sure that from a heritage perspective, because there are some heritage sites in the general region, that we have those closed off. So we've gone out of our way to ensure that's been done. And then last picture here just showing you some of the recent mining activity. In Geraldton, for those not familiar with Geraldton, it's a regional port owned by the Midwest Ports Authority. Mount Gibson has exported from there since 2004, and in that time it actually has constructed and owns 2 sheds, a large shed called the Berth 5 shed and a smaller one called the Berth 4 shed. The company has also built a train unloader which now belongs to the port, and the port owns the ship loader as well. So you can see a vessel in there at Berth 5, which this picture was taken a little while ago. That's one of the cargoes that we would have been sending out. So we have a good position in the port, a very good relationship with the Port Authority, and we're using that for the benefit of ourselves and other parties as well in looking at some surplus capacity arrangements. Just to touch on those, strategic port holdings, don't need to go through that again. So we can store up to about 6 shipments in the port, which is important. At Extension Hill, we have the rail refund, which I talked about, still coming to us. And exploration-wise, we're starting to gear up and do a little more regional exploration around some of these sites, Tallering Peak, Shine and Extension Hill, than we've done previously. And we're looking to enter into some farming agreements there and build that shortly. And then lastly, I just wanted to comment on our community activity. As Mike explained, from AngloGold's perspective, there's tremendous work that goes on into the communities, and we do our small part. Up in the Kimberley, we do a lot with local communities, local shires, and the like, Aboriginal groups, schools, etc. And we try and draw as many people as we can from the local regions to work at either of our operations. Traditional owners, we're grateful for the relationships that we have, and we've offered and try and employ as many as we can, in particular in the Kimberley area, where that's important to them. And we obviously have significant national impact, even for the spend of a relatively small company. It's something we take great pride in. And a few examples there of local communities at the bottom with whom we do some work and we support. So just in summary, we're an established independent iron ore mid-tier company. We're going through this year a waste capitalisation phase at Coolin. That's part of the plan. We'll stick to it, and that will see us come out the other side a bit later this year, and our grades and quantities will start to rise quite materially, and then from next year onwards, that operation will really be, from our perspective, a large cash flow generator. In the Midwest, we've just commenced Shine, so that's at least for a 2-year period for us and important for ongoing work in that part of the world. We have a desire to grow. We're obviously doing quite a bit of work in iron ore and looking at capacity deals for infrastructure in the Midwest, but also looking at other operations too, and in a stable and experienced management team. Many of you know that we've been around for quite a while, the core team that's still there now. And then importantly, the cash reserves sitting on our balance sheet are important for these type of investments that we're making, and they underpin what I consider to be a safe share price position. Thank you.
Thank you very much. Thank you, Peter. That was great, particularly some of those photos of the mines are amazing to look at. Is there any questions from the floor? Okay, we do have a few questions on the live stream. So first up, iron ore prices currently at historically high levels. Is it a concern if prices fall from here?
We prefer that they don't fall.
So would we all, yeah.
But they are, I mean, it's fair to say prices are at levels that I don't think anyone really expected. Mm-hmm. So from that aspect, or that perspective, we would assume that they will fall at some point, and we plan our business accordingly in scenario analysis. For us, Coolin is important because of the high-grade nature and the reduction in the strip ratio that's coming. We think that project will be cash flow positive at significantly lower iron ore prices. For the Midwest project, we will still need to watch it. The Midwest, you can't get away from the transport costs, but is still there is opportunity for us to bring those down as we continue that operation.
Great. Okay, one other question. Given the premium and discounts applied to high-grade and low-grade ores respectively, does it make economic sense to dilute your high-grade ores to produce many more tonnes of a lower-grade ore?
Okay, so that's a question about iron ore blending strategy, and it depends entirely on costs and price, in that it can make sense to put some lower grade material into higher grade cargoes as long as you're not degrading the overall specifications, but the benefit is the higher bulk. At other times, particularly in low price environments, can be quite difficult because you want to maintain the grade that's there. So it's a question of particular markets and the distance ahead that you're looking. Blending strategy for material that's already stockpiled is a common daily occurrence. Blending strategy for something that's budgeting, say, a year ahead is harder because you can't foresee where the price is going to be.
Perfect. Thank you very much.
Thanks.